I published a new post yesterday, December 11, 2025, discussing my trades just over the past few days. A link to my blog post can be found in my profile page here at YouTube. I increased over the past few days the dollar amount slightly of my purchases of beaten up dividend paying stocks, going over $2,000 by a small amount, as I attempt to replace lower interest income from my much larger allocation to Treasury bills bought at auction. The yields on those Treasury bills have been going down. I would classify myself as a dividend stock investor, although I do buy some minor dollar amounts in non-dividend paying stocks. And I would define myself primarily to be a contrarian value investor within that dividend paying stock space. So I'm not buying stocks anywhere near their 52-week highs. Most of the buys are currently in the equity REIT sector, and by equity REITs, I'm referring to real estate investment trusts that own property, real property, as opposed to mortgage REITs that own debt paper. I did buy 4 corporate bonds earlier this week that mature in 2029, and I would classify all of them as marginal purchases, but I have a tsunami of corporate bonds bought at higher yields to maturity, about to mature over the next several weeks and months, and those 4 bonds that were purchased are insignificant compared to the proceeds about to be received from maturing ones. I'm just not pleased with the yields of corporate bonds now in most cases. I will consequently pass on many new corporate bond purchases that I look at from an issuer and go instead with small ball purchases of its higher yielding common stock, or in some cases an equity preferred stock that has a fixed rate coupon that has a higher yield than the corporate bond, even though they, of course, have much more credit risk. I will generally own 300 to 400 different corporate bonds with maturities occurring each week over the next year and a half or 2 years, and after that, it's far more scattered as far as when the maturities occur. I am, in effect, running my own personal investment grade corporate bond fund. The duration was reduced to slightly more than 2 years by selling 122 bonds maturing in 2032 or later during the 2025 third quarter. Those bonds were bought earlier this year, and the total profit was $3,092. Links to my sell discussions of those bonds are in my November 1st, 2025 blog post. As expected, the Fed cut the federal funds rate by 0.25%. The new range is now 3.5 to 3.75. The Fed's rate hiking cycle that started with a 25 basis point hike off 0 to 0.25 in March of 2022 and ended with a federal funds range of 5.25 to 5.5%. The rate cutting cycle started in September 2024 with a 50 basis point cut in the federal funds range, followed thereafter by 4 25 basis point cuts. A majority of the current Fed voting members anticipate only one 25 basis point cut in 2026 and one more in 2027. If Trump is successful in appointing a majority of Fed voting members next year, which he will control, and the economy is faltering before the midterm elections, I would anticipate more cuts in the federal funds rate next year, and possibly a resumption of Fed money creation to implement another robust round of quantitative easing, where the Fed creates money to buy longer-term treasuries and mortgage-backed securities in order to bring down longer-term interest rates, which can be done even if inflation is moving significantly higher and the artificially Fed-created interest rates are far below the anticipated and actual inflation rates. For the 27 months ending in April 2022, the Fed increased the money supply by about 42% as part of its robust QE program, which took the 10-year Treasury yield down into a range mostly in the 1.3 to 1.75% range in 2021, even though CPI, consumer price inflation, increased by 8.5% for the 12 months ending in March of 2022. When this kind of interference in the market setting rates, the bond vigilantes aren't setting the 10-year Treasury yields by demanding a normal spread of around 2% to the anticipated annual average CPI over the next 10 years, but the Fed is setting the interest rate artificially. This also happened, as I said in the past, in the 5-year period ending after World War II, where the Fed kept the 10-year Treasury at close to 2.5%, even though inflation in some of those years was high single digits. I think one year went over 10%. Many economists believe that this 42% in the increase in the money supply, and it was rapid, contributed significantly to the problematic inflation in 2021 and 2022. Those are followers of Milton Friedman, who believed that inflation was primarily a monetary phenomenon. I cited some observations made by those economists in late 2020 and early 2021 in my blog that the Fed was in the process of causing problematic inflation with its robust money creation. My concern is that the Fed may now be proceeding down the same path that contributed to a rise in inflation in 2021 and 2022, as it ignores and underestimates the inflation risk while trying to improve the job market through rate cuts that are already low by historical standards before the cuts, and thereby causing more harm than good. And the projection materials, which I copied in my post from the Fed's projection materials from December 2025, the Fed is predicting a significant deceleration of PCE inflation next year compared to 2025, not an acceleration, and is predicting 2.1% PCE inflation in 2027 and 2% in 2028. If that forecast proves spot on, there is little danger from higher inflation resulting from an expansionary monetary policy. However, in my blog post, I copied the December 2020 projections made by the Fed on the eve of problematic inflation starting and about to rapidly gain steam. And as I said, these projections were made in December 2020. The Fed projected 1.8% PCE inflation in 2021, 1.9% in 2022, and 2% in 2023. So the Fed responded based on its monetary policy was based on its fear about the unemployment, not inflation. So the Fed kept ZIRP and quantitative easing throughout 2021 and into 2022, vastly expanding the money supply, believing that inflation was not going to be a problem. The projections made in December 2020 were, of course, way off based on what actually happened.